Welcome to Real Talk. I'm Andrew Dansker, your host.
I'm here today with Marco Lala, the Senior Vice President and Associate Broker at RM Friedland, also known as the King of the Bronx. But Marco, you have an alternate identity, which I want to mention here. You're not just the SVP and King of the Bronx at RM Friedland, but you're also a black belt in Brazilian Jiu-Jitsu, karate, and judo. And believe me, can go see you demonstrating your moves at fightingsecrets.com. Isn't that right?
FightingSecrets.com is the website, and then there's also obviously an Instagram, YouTube presence, Facebook. I have a page posting training videos and stuff. So getting back into shape. The lockdowns helped a lot. Lost 40 pounds during the lockdowns. Started doing some tremendous bicycling. I've done a couple of 100-mile rides on the bike besides all the other stuff. Bag work, jump rope, skipping, and everything. But I always looked at my martial arts as the perfect preparation for the commercial real estate. My commercial real estate career. I had to train and become a black belt killer so I can handle these New York City landlords. So it's worked out very well.
That sounds like good training.
That's right. Black belt brokerage. That's what I'm calling it now.
I like that. I think that's a perfect matchup. I think you said it sort of jokingly, but I think you're right. The mentality of excellence is about long-term patience and determination and consistent contribution to a goal. And I don't think that's any different. Tell me if I'm wrong in becoming a black belt as it is in selling real estate.
Absolutely. Look, one very, very specific example. I mean, it took me years, but I just sold a retail condo for Columbia University. I got hired 2 years ago on it. Between construction issues, insurance, because the building was brand new, the tenant wasn't ready yet, and then about a year in, COVID strikes. So that whole thing, they couldn't get in there and do the work. So we just closed on that a couple of weeks ago. That's 2 years to sell a retail condo. I mean, you can go nuts. The client was very loyal, kept renewing the listing agreement as long as they saw effort, in getting offers and maintaining the client relationship and things like that. That's patience and discipline, which can be applied. I mean, it's great to do the quick deals, but when you're working on something for 6 months, a year, 2 years, cultivating the relationships and clients, it's really it's amazing to see that finally come to fruition. So you're right. There's a direct application to any endeavor, physical activities versus also business and so forth.
I think that's great. I think that could be a whole podcast episode in and of itself, which I would love to do with you. But today we want to hear everything about the Bronx, because besides being a black belt in 3 martial arts, your other title is King of the Bronx, and that's the important one for today. So to start with, what I want to hear is what was the last 18 months like in the Bronx? Did the residential and commercial rents move at all? How did the local retail do? What happened to cap rates, or were there even enough trades to see the cap rates moving? What did the last 18 months, what was that experience like in the Bronx?
Well, I presume you're using 18 months because, the delineation with the HSTPA, the Housing Tenant and Protection Act, more or less, and then flowing into COVID. I always looked at that as like a 1-2 punch, an eye poke, and then a groin strike, if to using martial arts. It's been an absolute roller coaster ride. One point you had, with government media, intervention in there. I mean, they were on the rental agent side. You couldn't show apartments. You couldn't walk it. You couldn't meet people. So you had sort of goalposts. Not only were the goalposts moved with the Housing Tenant Protection Act in terms of the rent laws, then you got hit with government mandates like, oh, well, you can't see a client in person. Or if you were doing construction, you had to, I know developers that had 9-10 developments going on at the same time. 8 were stalled over a certain period of time. 1 or 2 they were able to start working because they had an affordable housing component to it. So they looked at that as kind of imperative for the continuation of developments for affordable housing. So the last 18 months has been absolutely a roller coaster ride. When we say, we asked, told I'm King of the Bronx, so to speak, I focused on a lot of rent stabilized, which includes a little bit of northern Manhattan and lower Westchester. I kind of looked at it as when I started my career 25 years ago as kind of a homogenous, although there are delineated submarkets, but the Bronx has been the bulk of my career. And I got to tell you, the dynamics there is the Bronx has always been like the last to benefit from appreciation and really good times, and then the first to get hit when there's a downturn, it seems like, over the last 20 some odd years, as I've noticed. So commercial rents, just to touch on some of those things, and cap rates real quick. The what we found, our firm, RM Friedland, we have killers when it comes to the leasing side of things. That's where they cut their teeth for the last 50 years, is a lot of this urban neighborhood retail, the barber shop, the hair salon, the nail place, the bodega. These things I don't think have been as affected by this Amazon effect, because as of right now, I can't get a Coke through the phone. I can't, if I got to buy a roll of paper towels, I live in an apartment building, I got to run to the neighborhood store. We've seen that actually hold up pretty well during these up and down times in neighborhood retail. It's the more regional, and obviously restaurants, although I'm sure we'll delve into it. It's like it's coming back. You've heard the stories about, the restaurant that was there for 20, 30 years, and the guy used his life savings or whatever. There's 15 restaurants ready to take that space up right now. There's somebody trying to go after the American dream. They might get a better deal on that rent now, so they're going to plow in the money. Then you got these SBA loans and the assistance and the rent and the relief. I'm very optimistic with the way things are going right now, but 18 months has been an absolute roller coaster ride. Cap rates, and we'll delve into that too, is really affected by the rent stabilized versus the free market assets. With the rent stabilized market, what people don't forget, COVID has kind of came and it's starting to leave, but the laws are still here. People kind of, they'll be reminded very quickly. And then they're adding layers and layers of regulatory requirements with lead paint requirements. If you have somebody under 6 in your building, every year you got to do the testing. Somebody moves out, you got to do swabs, and you got to become either lead free or lead safe. And local law 11 laws, carbon. It's just for some of the smaller landlords, it's getting a little bit difficult. And on the rent stabilized, all those methods of increasing the rents, people are saying to themselves, I got to make money now. So that cap rate went up. It was at one point the free market units were like the darling of the of the market when it came to multifamily, and I think that's still the case. But what's happening is the regulatory environment is almost becoming an overlay to even the free market units. How do you evict somebody? What are the requirements in the building of itself in terms of violations? The city's cracking down. They're sending out sanitation tickets. I have owners that have sent me videos where they have a sanitation guy showing up to the building, leaving his vehicle and putting a ticket on the building and wanting back in. I don't think he even looked around to see if there was garbage. The thing was already written out as he approached the building and got out and put the ticket on the building. It's been really the last 18 months, and I'm doing this 25 years now, has just been, I've never seen anything like it before. I have not seen anything like it before. If you go on some of my LinkedIn videos, I will tell you this, about 5-6 months into the lockdowns, a lot of the buyers were like waiting to see blood in the water. And I knew right away that if there was a deal that looked good, and I tried to tell this to some of my clients, instinctually, sometimes there's a good deal, right? And you're saying to yourself, what, if I wait another 6 or 7 months, I'll get a half cap rate better, or a multiple cheaper. There's probably 20 other people looking at that same deal. Somebody's going to take a leap at some point on that good deal. So you have to be very careful about how much lower you thought the market was going. And I think that's kind of done right now. Although some people are arguing like the forbearance stuff and some of the over leveraged properties, we still haven't seen that pain yet. But right now, over the last 18 months, I've seen a tremendous valley, and now it's starting to come back up. The question is, what's going to happen with the interest rate environment and all these things? These are things that are really the rent relief. It's getting a bumpy start, but it's been the craziest 18 months that I've seen in my 20 some odd year career. And that's going through Lehman, the tech bubble, World Trade Center attack. It's wild.
You mentioned a dichotomy between the free market and the stabilized units in the Bronx.
Yes.
How would you describe the difference between the two? Obviously, from a regulatory perspective, I think everyone who's listening understands the difference, but how would you describe the difference between investor appetite and cap rate for the two of them?
Well, look, I by example, like I just listed a very, very attractive 60 plus unit elevated building with low rents. It's 100% stabilized. stabilized. Although we have pretty healthy appetite for that asset class, it's just a reoccurring theme. It's like, Marco, where am I going to go with this? What's the future potential here? What guys are concerned with is that those rents are not going to grow fast enough, and the trajectory of expenses, real estate taxes. Look at fuel right now. I just had a client tell me their number 2 oil bill doubled for a gallon of oil. I mean, imagine your expenses are doubling and you have no means of increasing the rent. So right there, the guys that are looking at a lot of the stuff right now, and I'm kind of all over the place, are what I've noticed are the entrenched families, 2 and 3 generational families that have, look, it would be nice if you had a 1,000-unit portfolio. I can sell it for $1 gazillion and then go down to Florida and relax on the beach. Some guys can't do that. They got 50, 100 employees. They got 3 generations of family members working there. They're going to muddle through it. As long as they're not over leveraged, maybe some of the newer stuff they bought. But the rent stabilized is creating a challenge for owners that are trying to determine that, okay, if I can make a little money today, maybe in 5 to 7 years, these are actual conversations I'm having with people. It's going to be a tweak in the rent law. Maybe they'll add back in the vacancy allowance or do something, or maybe a new administration are coming in. And that in and of itself is a little bit of speculation. It's not a speculator or somebody who's syndicating, who's gambling on. I mean, we came out of a point before the rent stabilization market where the acquisition of real estate almost had nothing to do with real estate anymore. It was becoming just a financial instrument. They were anticipating, let's say in a 12 to 36 month period, some capital event would occur. I can sell at a premium, get my investors their return, right? Or refinance out of it, get everybody their money back, and then cash flow. But a toilet's going to overflow. You got to change. you got to snake out the waistline. You got to deal with move-in and move-outs and stuff like that. So a lot of these syndicators, maybe that was like secondary, but the older entrenched families right now, even with the rent stabilized assets, they know how to work a building, and they'll figure it out. But just my concern is though with the regulatory environment. I just had a guy look at a prop and he's like, they're proposing to get rid of the ability to combine a unit or change the footprint right now. So I can get to market rent. And even if, guys will even settle to getting to market rent and then get stuck with rent stabilized. If you can because if you got a studio or a 1-bedroom that can go for $1,700 to, let's say, $2,000, and you have a $900 or $1,000 rent, I can't get there. But if somebody moves out and I have a unit upstairs and you were able to configure or do something. Now, if they eliminate that, it's like what's going to be left at some point?
Well, was that ever a big business in the Bronx? I mean, certainly in places like Brooklyn for the let's say as of 2015, 16, 17. Maybe even into 18, it was still a strong business to go in, buy something stabilized, move some tenants out or wait for rollover. And there was a big delta between that stabilized rent and then the free market rent. So there was, like you said, a big pop in value based on a low cap rate on that move in income. And then you could have a capital event in a couple of years and make your pref and get out of the deal. What about in the Bronx? I mean, is there as much of a delta between the stabilized numbers and the free market numbers?
It's same philosophy. You may not have had the same pop where I went from an $800 or a $900 or $1,000 rent roll to $3,600, right? Or even $5,000. But you could in some cases you could almost double, not triple and quadruple. At some point, say how much money do you want to make? But there was enough of a delta there because of how low the rent stabilized environment was, in a lot of these buildings, and frankly, that's what triggered, right, the whole concept of let's eliminate all those.
Yeah,
you have MCIs and the AIAs and just the vacancy allowance alone. There were buildings. There were some buildings that I've sold or that are concentrated in like Fordham University and some of the college areas where just the sheer nature of the tenancy, where a student would move out every year. The guy didn't have to spend a gallon of paint even, but he was getting his 17 to 20% increase every year just from just natural attrition of students. So these rents were like. Their legal rents at like $4,000, $5,000, and $6,000 a month, So you get enough units where you went, you're getting $300, $400, $500, $600. Doesn't have to be $1,000 or $2,000 pop. That's going to help your bottom line. There's no question about it.
You mentioned Fordham, so I want to pivot for a second to the
Yes.
specific neighborhoods in the Bronx. And maybe you can give a little bit of color on how the specific neighborhoods in the Bronx fared in relation to each other. Were there any that were clearly stronger than the others in this choppy period, the choppiest you've seen in 25 years? Were there any that were particularly hard hit, either in terms of the move in residential and commercial rents or in terms of values of the buildings on the whole?
Well, in general, I think you saw less of a displacement in the Bronx. So there's about 3.5 million housing units in New York City. And I break it down by third. Like 1/3 is owner occupied, another third is free market, right? And market rate. Then you got about a million or so units are rent stabilized. Now, although I think Brooklyn has the slight advantage of number of rent stabilized units, it's interesting. It's not much. We're talking about only tens of thousands of units more than the Bronx, but Brooklyn has like 3 times the stock. When I did my analyses, of what we would target as investment property brokers, somewhere between like 80 and 120,000 properties in Brooklyn versus about 25 to 30,000 in the Bronx. But they're almost the same in terms of rent stabilized units, right? So you got about like, and 60% of that, 70% of the rent stabilized in the Bronx versus the free market and owner occupied. So the question of there weren't people like fleeing like they were in Manhattan. I had clients who were like, oh, I'm moving to my Hampton house, or I'm gonna rent a house for $20,000 a month for the first 6 months of the COVID lockdown. I'm living in a rent stabilized unit in the Bronx. I don't have the luxury of saying I'm going to move to my Hampton house and pay a $10,000 rent. I wouldn't be in the Bronx paying $1,200 for a 1-bedroom unit. So the issue there wasn't so much vacancy and displacement of tenants, was more, maybe even more on the order of collections. But ironically, people know what rents are. Like there was a section of tenants where, like, if I don't pay my rent on a $1,200, $1,300, $1,400 unit, at some point I'm going to be in court. I don't know how long it's going to take. I would rather not get kicked out of that apartment, because then if I go out, I'm going to be looking for something in the 2,000 plus range. It's just let me do my best to pay the rent there. So I didn't see that as bad as I did, in the core Manhattan markets and in Brooklyn and Queens. If that makes any sense.
Yeah, absolutely. People are protecting their stabilized units because essentially that lease is an asset.
That lease is an asset.
Yeah,
correct.
absolutely.
So,
but you mentioned Fordham a couple times in specific.
Yeah,
is that a particularly stable submarket that from what you know?
Yeah, the Belmont area, Fordham University, for like the last 20 years, I used to call that the best kept secret in the Bronx. One of the downsides there was from the transportation. It was like a 2-fare setup. Like there wasn't a subway thing that was like right on Arthur Avenue and 187th. But ironically, it was almost like self-sustaining. You had St. Barnabas Hospital, you have Fordham University. So there was a pocket there where, there's a little old lady with a 3-family frame house that's on a diagonal jammed up with students.
Right.
You know what I mean? It did take a little hit with the COVID, but you were probably able to default if there was a move out, like some students left. All right, backfill it in with a regular tenant. The thing where I get a little concerned about is, and I've been talking to some developers right now that have acquired development sites there, underwriting it with the idea that they're going to fill that thing up with students at between 1,000 and 2,000 a bedroom. All right, so or a bed. So if I have a 2-bedroom with 4 beds there, and they think they're going to get $1,500, that's like a 4, 5, 6. You should not be building in the Belmont area, Fordham Road, with anticipation of getting $5,000 to $7,000 a month rent for that apartment. Because if the shit if it hits the fan, I got to default to my average tenant, right? You should always underwrite using the average rental model, right? Whether it's in the prime Manhattan or in the Bronx. So
yeah,
but that was a blip. That was a blip. You go in those areas in general, like I always looked at New York City, like from a vacancy perspective, it's like vacancy allowance. And we use that in our setups and underwriting for collection purposes and so forth and so on. But like vacancy is like -2 in New York City. If you have a vacancy problem in your building in New York City, it's intentional. Either you're trying to warehouse the apartments or reposition the building or something like that. But there's no lack. You hear stories about people leaving the city and so forth, but it's a different discussion. people are coming in from all over to live in New York City. And, and things are starting to, there's some equilibrium coming back. Like, look, some deals are getting done right now, talking when we use a cap rate, right? A cap rate. I'll give you an example. I have a client that bought a building on the Upper East Side with studios and 1-bedrooms. When he bought it, they were like at $2,500 to $2,700. He asked me to value the building a few months ago. We did a sweep of rental comps, and we saw that the same size units within a half a block radius, they were like 27 or 30 on markets at between like 16 and 1900 for the same size unit. So let's say he rented those out, he decided to sell it. The cap rate's now based on that. But now as the market comes back, that tenant, right now, that's got that low rent because of COVID, when that lease expires, and if it's in a free market unit, I think there's going to be enough of demand. That's going to be an automatic pop right there on that, just from sheer demand and people, slowly seeping back into the city. There's no way a studio or 1-bedroom apartment is going to remain under $2,000 on the Upper East longer, in my humble opinion. Right. So that's an interesting, situation there where if you could buy in those situations, something like that, you might take a little bit more of an anemic cap rate, knowing that your rents have been artificially deflated by 15, 20, 25%. You don't see that in the Bronx. What you're looking at is more of like just business decisions. Like, here's the income, here's the expenses. Where do I think I can save? Are there other ancillary means of providing, generating income in there, whatever it be, laundry or other ancillary services or things of that nature. So, these are the things that owners are looking at. An economy of scale. Like right now, I'm doing a deal with a very prominent owner. They're buying left and right now, but they're up to like almost 200 buildings, so they have an infrastructure there where adding another 60, 70 unit building, there's almost zero cost to that. Right, other than the underlying costs of the building. They have the infrastructure, supplies, labor, everything is in there. It's factored in at a fraction of the cost.
I think the point you made about cap rates was a good one because the rents are bouncing around. Do you think that dollars per square foot is a better way of valuing buildings right now while the rents are in flux?
Well, it's interesting that you say that. As a Bronx broker, it used to be, I used to get a chuckle when we discussed price per square foot on a building, right? It's like it's a multiple or price per unit. Now, we know we're all experts here, right? There's like 4, 5, or 6 metrics, right? You have price per unit, price per foot, cap rate, and multiple. Let's say those 4 metrics. Every one of those is skewed when looked at individually. I also broke them down by income producing metrics versus the physical metrics, right? You have price per unit and price per foot is not really a derivative of the NOI or what have you. The price will determine those, but then if you have a cap rate and multiple of a rent, I have $1 million rent roll, 10 times is 10, right? So if I have 20 units, they could be 400 square foot apartments or whatever. What I started finding out when I do my analyses, because we look at every metric and then it's an educated guess. I started seeing that the price per square foot, I looked at as the lowest common denominator. You know what I mean? So if I saw a building in the Bronx that sold for, let's say, $150,000 a unit at a 6.3 cap, at 9.2 multiple, and if I had enough of those and I looked at the price per unit, I saw more definitiveness in the price per square foot. And now It's funny, doing a lot of development sites, we're talking air rights. I'd laugh at, like, we're talking about air rights in the Bronx. A development, an as of right deal used to trade for, $20, $30, $35, $40 a buildable foot. Now, we're doing, I've done deals at, 90, 100, 110, 85 a buildable. Still not the city, where it's, $400, $500, $600 a buildable foot. But the price per square foot, I think, is a very, very strong indicator of value. And I think that goes across the board in every asset class, every metropolitan market, across the country. Price per square is a very strong factor.
Where do you think the price per square foot for residential buildings in the Bronx is today? What's the range on that number?
on your garden variety multifamily building, again, depending on elevator, I've seen as little as 105, 110, upwards to about 150, 160 a square foot. And what's mind boggling is, you would think, and unfortunately, because of the laws, like you have an apartment building, you can't build that thing for for $500, $400 a foot. You got to acquire the land at 50 to 100. You got construction costs at $300 a foot hard, then soft costs on top of that. But we're seeing I wanted to try to keep it tight, but between 100 and 200. I'm not talking about new construction with 421A tax abatements on them, which is a whole nother crap show that I'm seeing right now. You got all these buildings that have anywhere from 5 to 11 years left on their 421A tax abatement. I'm selling a couple right now. Now, back in the day, it used to be like if the abatement was more than 10 years, you could use the current NOI and get away with it, right? Because the bank's they'll be out in 5 to 7 years. They have no, but I'm doing, now if you do a 421A tax abated deal at $300 a square foot, and you're hoping the thing goes free market, right? In 8 years when the abatement expires, there's a couple of dynamics there. First of all, the tax, we have eight families. The current tax is $2,000, $3,000. The assessed value has them at $65,000, $70,000 for an 8-family. It's crazy. There's a cottage industry right now on lowering the assessed values on tax abated buildings. A tax search ERE to lower the taxes on an abated building. So how do you you're not really saving taxes, so they do it on a per unit basis or per building basis. But I know I'm kind of all over the place there. But so now you got a building the loan's going to mature, let's say in a 5, 7, or 10-year model. The abatement expires. How do you refinance out of that if your taxes go up, 500%? Now, but it's going to be free market. You know that the day before the 421A expires, if you renewed a 2-year lease at rent stabilized, that person's in there for 2 years under a rent. So there's going to be a kind of a period where, when will you really hit total free market status? Now some people are the sales pitch is at that point, there's going to be a myriad of other programs you can utilize. I'll put another 30-year abatement on there. Or I'll do something, I'll cooperate with the city, or I'll modify, I'll do the building over. But, with what happened with the law change, how do you predict now what the sentiment's going to be like at that time? You know what I'm saying?
Right,
so,
right.
But I hope that answers your per square foot.
Yeah, it does. It does. I have a few other questions. It's good. I want to ask you two wrap-up questions. The first wrap-up question I have for you is, if you had $2 million to spend right now in New York, what would you buy?
I was going to say Bitcoin or Dogecoin or whatever that is. No, but in $2 million in New York, I could probably buy a little bit more now. I mean, I remember guys used to tell me, "Hey, Marco, I got $1 million. What can I buy?" And I remember at one point when the building prices walk-ups were going over $200,000. I might be able to get you an 8 to 10 family if you put 50% down, because the bank's not going to underappraise it for that amount. But I'll tell you what I like. I like the free market properties that are under 6 units, 5 and under, with a mixed use component. I would buy that stuff all day. 4 or 5 apartments, with a couple of stores in a decent retail traffic neighborhood, or 1 or 2 blocks away from a train stop. I'd buy that stuff all day. That's what I would do, 100%.
What if you didn't have to be confined to New York City? What would you buy?
I'm a little biased there. Like I'm a small investor. I live in Bergen County, New Jersey, and I equated Bergen County to Westchester. So imagine like these kind of bucolic type, Scarsdale, Ardsley. Then you have in Bergen County, Paramus, Hasbrook Heights, or whatever. And this is something that I saw over the 20 some odd years in working smaller properties as well as big properties. These, in Bergen County, out of the 70 towns, for example, almost all of them there's no rent restrictions. And the couple of pieces that I bought from like the old Italian guy that had it in the family for 30, 40, 50 years. If you ever drive around towns like that, or like in Westchester, or even like Riverdale or what have you, you see these 5 to 10 unit buildings, in these little, I call them gold nuggets. They never leave the family. They're always rented, slow and steady rent increases. You understand what I'm saying? To me, that's real estate. Somebody said, don't wait and buy real estate. Buy real estate and wait. That's the apropos phrase there. Phrase. So when you ask me if I had 2 million, I wasn't confined to New York City. Wouldn't rule New York City out if I can find an asset that falls in that category. Would I love to have a 100-unit building in Midtown, luxury rental, whatever? You're going to deal with your own array of issues there. But give me 10 families spaced out, in a bucolic. I like garden style apartments. I just fell in love with garden style apartments being out here in Bergen County. On-site parking, maybe a garage in there, separate utilities and so forth and so on. To me, I find that as a kind of family-oriented business, hands-on management. Like that would be what I would do with the 2 million. You think we can raise that? Are you ready to let's do it. Let's do it. Let's blow it wide open.
Well, Marco, I appreciate all the information that you shared today. I think it's fantastic look into what's going on in the Bronx, and I can't wait to check out fightingsecrets.com and see you in action. And I really appreciate the time. Thank you.
It's my pleasure. Thank you for the opportunity, Andrew.
Thanks for listening. That's all for today.